Okay, let's do an abbreviated discussion of fire insurance. When we buy fire insurance, there are two things that we want to insure. There's the building, the structure, and there are the contents. If we're renting our dwelling, an apartment or a house or a condo or whatever, if we're renting, the owner of the building is paying the insurance for the building, for the structure. We may want to get some insurance on our contents, our furniture, our stereo, our clothes, that sort of thing. But if we own a business or we own a home, then we're buying on both of these things. Now, how do they determine what our rate should be? Well, just like anything else, the more likely our structure or contents are to burn, the higher we're going to pay. So, if we have a brick building with a steel roof and it's in a residential neighborhood, that's going to have a relatively low rate. If we have a frame building with a cedar shake roof that catches fire real easily when sparks come out of the fireplace, and we're 2 miles from the nearest fire hydrant, that's going to be a higher rate. If we own a building that's in the warehouse district and it's next to an oil refinery, that's going to be a higher rate no matter what our building's like, because oil refineries can explode. So it depends on how likely your building is to burn. Now, if we're in a business, we would have separate insurance on the building and the contents. So we'd have a different rate on each of those, because we could have a very nice building in terms of not easily burned, but we could be storing gasoline in it. Okay, so the contents could be very flammable, and the building could be not as flammable. By the way, mentioning that word, we need to talk about one thing. In the English language, when we put the prefix "in" in front of a word, what does it normally mean? A person who's insane is not sane, right? It normally means the opposite. Active, inactive. Okay? So when you see "in" in front of the word, it normally means the opposite. However, in this case, inflammable and flammable mean exactly the same thing. So that's a good thing to know. If you see something that says inflammable and someone says, "Oh cool, it won't burn, let's try lighting it," you're about to have an explosion. Inflammable and flammable mean exactly the same thing. So if somebody wants to say something is not easily burnable, they use non-flammable. All right, so I just thought I might save you or one of your relatives from an untimely accident just by knowing that inflammable means the same as flammable. Now, if we're in a home, if we're buying homeowners fire insurance, then the building and the contents normally have a specified ratio. So for instance, if we insure our home for $100,000, then typically there would be a 50% of that as part of the insurance for the contents. And then if you had more expensive contents, you could pay extra to up that. If you had a particular item, you can buy what's called a rider on that item. So if you have a very expensive antique or a very expensive piece of jewelry or a musical instrument, that sort of thing, usually it's very inexpensive unless you're a professional in that. If I have a very expensive musical instrument, it's very inexpensive for me to put a rider on that so that if anything happens to it, I get full value for that. But if I'm a traveling musician and I'm always carrying that around and it's always in a vehicle and it's always in a place where it could get stolen, then it's going to cost a lot more to insure that. So you just want to look at what you have and see what's going to be the most effective thing for you to do. Now, there's one thing we need to talk about. If someone cancels their policy, what happens? How much are we charged? Because obviously we pay the premium on the front end. Any insurance, you always pay the premium on the front end. Otherwise, people would just wait till they had a fire and then they'd go out and get insurance. You got to pay for it before the thing happens. If the owner of the company, in the book they give an example of somebody owns a dress shop, and let's say she's paying $2,000 a year for her fire insurance, and she says, what happens if after 7 months I decide, you know, I'm not going to make it and I get out of the business? Well, do I get any of that money back? And they say, yes, you do, but you don't get back the exact prorated portion. You would get back a certain amount according to what we call a short rate table. And that short rate table in our current edition is on page 478. Notice it says the time the policy is in force in days and months. Notice you can buy a policy for 5 days, but you'll pay 8% of the annual premium for that 5 days. Now, why would someone want to buy fire insurance for 5 days? Well, let's leave arson out of the picture, okay? We'll assume that we're going to get caught if we do that. What about a fireworks stand? It's only there for a short period of time, a short window. What about somebody who does a weekend carnival or something like Riverfest on Memorial Day weekend, and they've got, you know, a bungee jumping ride? They want accident insurance just for that weekend. So they say, we'll sell you. I mean, we'll sell you anything if the price is right. So that short rate table is used. So in the example in the book, if we cancel after 7 months, if the insured cancels after 7 months, then we'd look at the short rate table, and under 7 months, what percent of the annual rate would we be charged? The table says 67%. So we would end up paying, we'd pay 67% of the annual charge, so we'd get refunded 33% of it. Okay? So if there's a problem that says, how much would her refund be if she canceled her insurance, we'd look on the short rate table and we'd say she's paying 67%, so 100 minus 67, she's going to get refunded 33%, and we'd multiply that by her annual premium. So the refund would be 33% times $2,000, and that would be $660, is that right? So that's how much you'd get refunded. Now, what if the insurance company cancels her after 7 months? Now, how could the insurance company cancel her? Well, they could come by and inspect it and say, hey, you need to move this kerosene that you're storing in your attic. We're going to come by again next week, and if it's not gone, we're canceling your insurance. And they come by next week and she hadn't moved it. If the company cancels her insurance, then they have to prorate it. In other words, they would have to say, we can only charge you 7/12 of a year, and we're going to refund you 5/12 of a year. Okay, so if the company cancels the policy, the insurance company cancels, they have to prorate it based on the amount of time you've been insured versus how much you've paid your premium for. But if you cancel, then you pay on the according to the short rate table. So in other words, it's completely prorated if the insurance company cancels on you, but if you cancel, they charge more because there's been the administrative overhead and, you know, all that stuff. Any questions on that?